Hi, I wanted to spend a little bit of time to really talk about the international markets. The United States has handily outperformed the international markets for several years now, especially the developed international markets. You saw some reversal of that during the first quarter of this year. And then since mid-April, since the tariff conversations have really been pushed back, you've seen the US markets come back pretty substantially. So I think the big question is from here, looking forward, where should we see the best growth from a global perspective? So if you just look at valuations, the developed international markets are trading around 14 times earnings, and you have the United States trading at well over 20 times. So United States is a much more expensive market. Just at its surface, it looks like Europe especially might be more interesting. But if you really dig into it, part of the reason for the difference in valuations really has to do with how much people have spent and invested in AI. And AI moving forward should be a big driver, should continue to be a big driver to the economy and also to operating earnings moving forward. Companies should have better operating leverage. That should result in higher valuations. We've seen that really since COVID, and that's a trend that should continue to happen moving forward. So if you look at the end of 2023, the United States has invested about $67 billion in AI initiatives. Whereas if you look at Europe, they've only invested $11 billion. And that's part of the reason really that we see the big difference in valuation disparities between. And even if you look at technology as a sector, as a percentage of the different indices, technology is around 30% of the S&P 500. And then technology is only, if you look at the MSCI EFI index, technology is only 8%. It's substantially lower. Most of that, the composition of the is really around financials and industrials, which are slower growth sectors, which also accounts for the valuation difference. So part of the reason that you see the developed markets really outperform the US is when the dollar is weaker. And you could certainly make the case that the dollar will continue to be weaker because the deficit has grown substantially in the United States. And we have an administration that is more supportive of a weaker dollar. So if that continues, you should see pretty decent performance from the developed international markets. But what I think is much more compelling is really the emerging markets. So emerging markets only trade just over 12 times earnings. So they're substantially more cheaper and they're growing more rapidly. So currently, every emerging market outside of Brazil is in the process of cutting interest rates versus the United States that has not started cutting interest rates. And anytime that we've seen a prolonged period where the dollar has been weaker, you've seen really nice outperformance in emerging markets. And also what's a little bit different about the asset class is from an active manager perspective, it's usually where you see active managers performing better and with a higher chance of outperforming an index is really in the emerging market area. So allocations to international make a lot of sense, especially to the emerging market sector of international. And I think that will likely continue to be the case in the second half of the year. As long as we have an administration that is supporting a weaker dollar, allocation to international makes sense for clients. Thank you.